The economic buzzword for most of 2021 has been inflation. But is it being replaced with an even more fearful term? That's our jumping off point in this week's fastest 4 minutes in finance. Hello again, I'm Scott Inman. Well, we've discussed inflation many times here on the Fastest 4, and while it is still running hot, it's not really the hot topic anymore. There are now growing concerns that stagflation is right around the corner, and that would be bad. So first off, let's get a grasp of what stagflation is. According to dictionary.com, it is persistent high inflation combined with high unemployment and stagnant demand in a country's economy. The term is often associated with the 1970s, which saw runaway inflation largely driven by high energy prices and lackluster economic growth. One way to gauge the potential for stagflation is to calculate what is commonly referred to as the misery index. That's inflation plus unemployment. So take a look at this chart from LPL Research. It shows us that the misery index is nowhere near where it was in the 1970s. In fact, over the past 50 years, the index average is right around 10, and that's about where we are right now. Certainly, we do have high inflation. In July, the Consumer Price Index was up 5.3% year over year. That was the largest jump since 2008. It remains to be seen, though, if these jumps will continue or if improvements in the supply chain and more of the economy not only being reopened but normalizing will bring these prices more in check. Many of the commodity prices that were ringing alarm bells this spring have dropped. Remember lumber? Prices are out of control in some places. Take lumber. Lumber futures hit an all-time high last week of $1,260 per thousand board feet. That's more than 3 times what it was a year ago, and the price went even higher by the end of the week. Well, lumber prices have dropped 70% since May. Copper prices are down 15%, and the other two components that traditionally make up stagflation are not really there currently. The unemployment rate is not back to pre-pandemic levels yet, but the most recent job report showed that the economy added nearly 1 million jobs in July, bringing the unemployment rate down to 5.4%. As schools reopen and supplemental unemployment benefits expire in early September, there is the potential for a lower unemployment rate, and we certainly do not have lackluster economic growth. Bloomberg's survey of economists is estimating 4.2% GDP growth in 2022. The survey estimate for 2023 does slow a bit to 2.3%. Bottom line here is stagflation is understandably a concern. Low growth and high inflation lead to a situation where the vast majority of people become poorer. However, the evidence does not indicate this to be a likely scenario, and we expect recent inflation readings to moderate and growth to remain at a solid speed over the next year. This could bolster the case for stocks to add gains through the remainder of 2022. Thanks for watching.